What I would really hope for is that people increase their understanding of the relationship between the VIX and the S&P index, that it's not just that they're correlated because they are correlated, but there's actually a risk premium they share, and that explains more or less why they should move in the way together that they do. So I would argue that they're actually pretty much the same thing. So the volatility risk premium does contain the equity risk premium, and therefore the price of an option or volatility itself will contain the movements of the underlying the S&P, and that causal relationship is what I also try to focus on in my work. Basically, whenever the S&P moves, the VIX will also move. That move of the VIX is based on two factors. So the first factor is the actual change in the underlying. If the S&P changes, the implied volatility at the money will change because of the implied volatility skew. And then that whole skew will shift up or down just because of changes in perception about future risk. And the first part is more or less a given. And the second part is the more idiosyncratic risk profile of the VIX. But most of the time, the first part dominates, but then there are certain times and environments where actually that volatility risk dominates. And one of those times is, for example, the low volatility environment. So as I tried to mention, the two risk components, while they are related and usually that underlying risk dominates in low vol environments where low is already very compressed and cannot go any lower, you start to see a profile where that volatility risk actually is the one that dominates. So if the realized risk of the S&P is, let's say, 5% or even lower on an analyzed basis, there's really low chance of it going even lower. But there's a big chance of it spiking up a lot. So what you get is a one-sided risk profile where you basically share all the risks of the S&P declining, but you get none of the benefit of the S&P increasing and therefore volatility falling further. And so you're having more or less an uphill battle in shorting vol in that environment. So I was asked that question eventually in 2017, where after years of being more or less bottomed out at 10 for the VIX, we saw, I think, 25% of all trading days that had a closing value of the VIX below 10, and it kept on going lower and lower and lower, and people started asking, like, where can it go? Is it zero or what is it? And given some technicalities about the option market, the volatility skew namely, and also the requirement for a risk premium for expected changes in volatility, it cannot be zero. And so the framework I designed basically allowed me to analyze an environment where I could simulate a zero realized vol, and the number I came up with was 6. So if even if realized vol would be 0, I would expect the VIX to be somewhere around 6. Well, I've joined the conference more or less since the VIX Futures started in 2004, and basically that's also what brings me back. I think it's the key conference for VIX-related products. That's also my main focus area, and it's a great product and a great conference, and I'm happy to be here and also help others understand a bit more about the VIX and related products.